Thanks, Iram. I'm Bill Korn, CareCloud's CFO. I joined the company almost 10 years ago before our IPO and have enjoyed growing the business from $10 million to $140 million. CareCloud has grown at a 44% compound annual growth rate from 2017 through 2021. The majority of this growth was from acquisitions, as we spent only 2 to 3% of our revenue on sales and marketing from 2017 through 2019. But investors regularly told us that they cared more about our organic growth rate, so we started investing in sales and marketing in 2020. This year, we took a breather from acquisitions as we haven't found a company with an attractive enough valuation. We look for profits or cash flows which will provide a return on our investment in 3 to 4 years, and we haven't found a compelling deal recently. We started this year knowing that 2 large hospital customers were winding down, but not knowing exactly when. Each of these hospitals was acquired before we inherited their contracts during an acquisition we made during 2020, with each moving their systems and processes to those used by their acquirers. They each transitioned mid-year, ultimately leaving us with $10 million less in revenue than we received from them in 2021. We were able to fill this gap with new customers, as well as growing revenue from our subsidiary MedSR, which we acquired in mid-2021. So even though a graph showing revenue that's essentially flat doesn't seem that exciting, it's a moral victory backfilling the revenue from these 2 hospitals. It's too early for us to give guidance for 2023, but I wanted to share our thinking. We'll have the same phenomena as this year, since these 2 hospitals will generate $11 million of revenue in 2022. At least we know the timing, whereas this January, we didn't know when these transitions would occur and whether we'd lose 1 month of revenue or 10. In addition to these 2 hospitals, we always plan for some customer attrition. Doctors retire, sell their practices, and sometimes they switch providers, even with the best of customer service. We always have a placeholder in our plan to account for this. However, for the first time in our history, we have 3 organic sources of new revenue, which will allow us to grow even without acquisitions. We expect $3 million of revenue growth from existing customers who ramped up during 2022. We expect $14 million of revenue from new customers, primarily those who signed up this year. And we are estimating that CareCloud Wellness will generate $4 million in revenue as patients start to use our new chronic care management and remote patient monitoring services. If we didn't have the impact of these 2 hospitals, we might report net organic growth of 10% or more, which would be phenomenal. Even with the $11 million headwind, we still expect we'll be able to provide a guidance range for 2023 in January, which will be higher than our 2022 revenue. But 2024 will look very different. We will have the same upside from new customers and new products without the decrease from the hospitals. So at that point, our net organic growth rate will shine. And of course, we are always searching for an attractive acquisition to ratchet up our growth. It is useful to look at our margins in a little detail as well, so you can think about what we might be looking at in 2023, as well as our steady state margins. While we expect our overall adjusted EBITDA margin will be essentially flat from 2021 to 2022, there are a couple of important dynamics. First, we are steadily growing our investment in sales and marketing, and despite that, our core healthcare IT business should generate the same adjusted EBITDA margin as in 2021. The MedSR professional services business, which we purchased in mid-2021, was essentially break even when we bought it. We have steadily improved its profitability. While we're estimating it would generate approximately 13% margin during 2022, if we could break it out as its own business, its gross profits are higher in Q4 than they were earlier this year, and its overhead is lower, and we anticipate it will generate over 20% margin during 2023. Our practice management segment should see flat profitability in 2023. So despite spending more on sales and marketing in total next year, you can expect to see our overall adjusted EBITDA margin grow. No topic generates more questions from investors these days than our capital structure. Our stock price is down 48% over the last 12 months, although some of our peers are down more. NASDAQ is down 30% overall, and all small cap growth companies have suffered as the Fed raises interest rates and investors speculate whether there will be a recession and which sectors will be hurt the most. With our share price and the market cap of our common stock lower than at the time of our IPO, when we had $10 million of trailing revenue and $1 million of adjusted EBITDA, we have relied on non-convertible preferred stock to raise the capital for growth, with the plan of selling common stock when our share price was in line with our peers to redeem the preferred shares. While our plan remains unchanged, the question is when to issue common stock. Selling shares at too low a price causes excess dilution, but waiting for too high a price means paying additional dividends. If we believed our enterprise value matched our peers and our stock price was appropriate today, selling common stock and redeeming preferred stock would simplify our cap table and increase cash flow to common shareholders. We know there's a wide range of possible share prices in the future, but our challenge is to decide when to sell common shares. If we sold 41 million shares today at $3 per share to redeem the outstanding Series A preferred stock, we'd save $12.5 million in annual dividends, but that would mean almost quadrupling our common shares outstanding. If we waited to sell common until the stock was $7 a share, for example, we would only need to sell 17 million new shares. While we can't predict our future share price, we can say that if we wound up with twice as many shares outstanding, then the value per share would be approximately half, assuming the same total enterprise value. Even if we saved $12 million in dividends by redeeming the Series A preferred stock a year earlier, the impact of the extra common shares would be far greater than the impact of the $12 million saved. But the benefit of waiting for a higher price isn't absolute. If we wait too long, the price may never hit the threshold we've set, in which case we might never redeem our Series A preferred shares. We could hedge, perhaps selling $60 million of common stock at one price, waiting for the price of the shares to react, and selling more shares in the future. I've shown a couple of examples on the slide as well. While we can't predict our future share price, this analysis suggests to us that patience might let us create a higher eventual value for our common stock. You can try this using whatever you think is the appropriate value based on our projected future revenue and profitability. But as long as you use the same enterprise value in each scenario, you'll see that the graph looks similar. As a management team, we're focused on growing our business and its profitability, and we'll wait for a valuation where we think it makes sense to recapitalize. As Hadi mentioned earlier, when we went public in 2014, we were known as Medical Transcription Billing Corporation. At that time, 75% of our revenue was from medical billing. During 2021, we changed our name to CareCloud, the name of a company we purchased in 2020, reflecting the fact that 84% of our revenue today comes from technology-enabled solutions. We're now ready to take the final step, changing our ticker to match our name. On Tuesday, January 10th, 2023, we're changing our NASDAQ ticker from MTBC to CCLD. At the same time that our common stock ticker changes, our preferred stock tickers will change to CCLDP and CCLDO. You've heard a lot today, and I want to leave time for questions, so I'll wrap up by summarizing why we're all excited about CareCloud. We are the leading cloud-based healthcare platform with new digital health offerings combined with a low-cost offshore services team. We have generated record revenue growth over the last 8 years, driven by organic as well as strategic initiatives. And we have a history of rapidly integrating large acquisitions, driving enhanced scale. We look forward to continuing to grow our business, knowing that we're serving a huge market and adding a lot of value for our customers. We look forward to adding similar value for our investors. With that, let's turn to questions. I know we said that we would wrap up by 3 p.m., but feel free to send us your questions via chat, and we'll answer as many as we have time for.